Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, with my co-host Brian London. He's in New Orleans. We've got Rick Roll on the line up in Vancouver, Canada. And Rick has dedicated his entire adult life to natural resources investing. And he is the president and chief executive officer of Sprott US Holdings Inc. He's a frequent speaker at many industry conferences. He has his own Sprott Natural Resource Symposium coming up at the end of the month in Vancouver. And he's a regular speaker at the New Orleans Investment Conference, and he's been a past guest on the show. Rick, welcome back.
A pleasure to be with you. Thank you very much for having me on, both of you.
It's our pleasure. And just as we were preparing, you made a comment about how you do not get tied up so much in, let's say, the short-term comings and goings or meanderings, and you really focus on the long-term or secular trends. Now, this is relevant because, of course, there was this breakout, which among the gold bug community got a lot of attention. But to you, that was maybe pennies or not so relevant. Why do you think it's not so important in the grand scheme of things?
I would say it's a data point. You know, when people talk about the psychological importance of certain numbers, those are people who have a very short-term orientation. I have a very different orientation. I'm looking for real increases in wealth that occur as a consequence of fundamental change in a commodity, in an exploration project, in a mine. As an example, Brian will remember me at his conference in 1999 pounding on the podium trying to cram people in the uranium trade. Uranium was then about $8. I thought it could go to 40. The move in uranium from, say, $8 to $10 was interesting psychologically, but the cost to produce uranium in those days was $25 a pound. So what happened is that the industry became marginally less uneconomic. The thing that really mattered was to understand that the uranium price had to go above $30 from $8. Now, that could take 3 years or 4 years. In fact, it took 6. But when the move that had to take place did take place, uranium went from $8 to $130, and the stocks went absolutely ballistic. The truth is that if you take the risks that I take in exploration, in cyclical businesses like commodities, if you are playing the game for a short-term, even 25% trade, what you're really doing, I think, is bending over to pick up 25-cent pieces in front of a steamroller. I am, given the risks I take, looking for dollar stocks that can become $10 stocks. And characteristically, Tenbaggers take 5 years or 6 years. Most people don't have the orientation to allow themselves to wait long enough to actually make money. You know, I was commenting about the sort of arbitrage between short-term expectation and long-term reality. The circumstances that have made me real money in my life boil down, I think, over 35 years to something like 29 really, really, really good trades. I've certainly made more than 29 trades, but those 29 trades account for most of my net worth. And in a little internal work that Sprott did, our history of Tenbaggers, I think is what we've called it, the average 1,000% gain has required a little more than 5 years. And interestingly, most of the 10-for-1 trades that I participated in had at least 2 down cycles individual to the stock, where the stock fell by 50% or more. So you had to wait 5 years, and you had to endure 2 50% declines to get a 10-bagger. That's the difference in orientation between most people whose investment methodology is got a hunch, bet a bunch, and people who become actually successful in the more speculative parts of the natural resource business. So sorry for this long-winded answer, but it's a great question. Looking at the move in gold from 1250 to 1400, in actuality, it's an interesting move for the producers because all of that $150 is margin. But I actually believe myself, given the fundamentals behind gold, and in particular the fundamentals associated with U.S. Treasury securities, which I regard to be the anti-gold, I'm not buying gold for a move from 1250 to 1400. I'm buying gold because I think there's a possibility that gold clears 1800 or 2000 or more. So while I guess the $1,400 number is a data point, and it certainly has the people who like to be put into a tizzy, it doesn't matter to me at all.
Rick, a lot to go over from what you just said. But first off, the move for gold from under 13 to over 1400 recently is a short-term move, and in the long term, it is a blip. But don't you think from a longer-term perspective, when I say longer-term, like going back to December of 2015 when we seem to have reached that bottom, that it looks like this move is kind of confirming that long bottoming process, that kind of saucer-shaped process, and even kind of the handle to the cup kind of a thing, that where gold seems to be confirming that it's ready for a major move up to those previous highs?
I'm not being cute with this, Brian. You are better at that type of thing than I. I have a recent video out there, you might link to it, where I actually use a gold stock chart for the first time in 35 years. But it's a 40-year chart. Mm-hmm. It doesn't cover small moves. I mean, I really will have to leave the shorter term analysis to you. The way that my work goes, the move from 1200 to 1400 was interesting rather than relevant. I am not trying to say that technical analysis is irrelevant. I'm just trying to say it doesn't fit into what I do at all. I used to love Jim Dines at your conference, who had all these wonderful charts and all these lovely young ladies displaying them.
Oh, you mean the original uranium bug, right?
Yes, the original uranium bug, the original gold bug. He could make technical analysis sound so attractive. I'm not saying it isn't. I'm just saying it doesn't figure much into my work. The moves that I respond to are probably, well, I would say that they're possibilities rather than probabilities, but they have enormous payoffs associated with them, which is how I play the game.
So what is your thesis for those much higher gold prices into the $18, $19, or over $2,000 range?
There are many factors which in the near term impact the gold price, but in my life, the most important trend has been the strengthening U.S. dollar as expressed by the U.S. 10-year Treasury. The move to quality when people are nervous in world markets since 1982 has been into U.S. Treasury securities. And I think right now gold's primary role globally, not just in the United States, globally, is a measure of investor confidence in the stability of the purchasing power of the U.S. dollar. I would argue that the U.S. dollar and the U.S. economy have been relatively strong rather than absolutely strong. That is, they have been strong in comparison to very weak counterparties. I believe that the U.S. Treasury securities have been in a bull market since late 1981. That is to say, a greater than 30-year bull market. And in my experience, markets of that duration are long of tooth. Certainly, during that period, interest rates are, of course, inverse to the price of the bond. The 10-year Treasury has fallen from, 15.6 to 2, meaning, in effect, that the bond has gone up ninefold. I would suggest to you that that bull market is either over or nearly over. I may be wrong. There are a number of government-issued treasury securities worldwide that trade at a negative yield. I will leave it to others to justify lending money to France for 10 years with a guaranteed sub-zero rate of return. Jim Grant called that, of course, return-free risk. I would just suggest to you that if you buy my thesis that gold trades contra to confidence in the purchasing power of the U.S. dollar, and the U.S. Treasury market is closer to the end than to the beginning, then the move in gold is closer to the beginning than to the end. And I think that's justified by simple arithmetic. The on-balance sheet liabilities of the U.S. federal government exceed $20 trillion. The off-balance sheet liabilities, that is, unfunded mandates, exceed, according to the Congressional Budget Office, $100 trillion. So the combined federal government debt, not state and local, federal government debt exceeds $120 trillion. Now, how do we propose to pay for this? Well, of course, from net government income, which right now is negative $1.5 trillion. So the value proposition for the U.S. 10-year Treasury is that you are part of a $120 trillion obligation that's being serviced by a string of deficits. I challenge anybody listening to this podcast to explain to me how you add a column of negative numbers and come up with a positive sum. I think that this goes along, this being confidence in the U.S. dollar, goes along until it doesn't.
Right.
We saw a situation in 2000 where gold was relatively strong in conjunction with a strong U.S. dollar. It happens very, very rarely. And then we saw the U.S. dollar in 2001 begin to roll over. And the circumstance that we saw there over 10 years was a move in gold from $250 an ounce, when it couldn't catch a bid, to over $1,900 an ounce. I'm not suggesting to you that there is a move in that order of magnitude in gold, but I would suggest to you that we have seen a circumstance in the last 18 months where gold and the U.S. dollar were simultaneously strong. And when I look at the numbers associated with maintaining the purchasing power of the U.S. dollar, that is, federal debt and deficits, I believe that the stage is absolutely set for a move in gold and at least a questioning of confidence in the U.S. dollar. Let me give you one more stat, Brian. I know I'm wearing people out with my fixation on arithmetic, but gold, well, precious metals and precious metals-related equities are alleged now to have a market share of between 1/3 and 1/2 of 1% of savings and investment assets in the United States. Less than 1/2 of 1% of savings and investment assets in the United States are precious metals and precious metals equities related. At the end of the 1980s bull market in gold, the same number was over 8%. So the market share of gold and precious metals in the U.S. market has fallen from 8% to less than 1/2 of 1%. The 3-decade mean is between 1.5% and 2%. And I am not suggesting to you that gold will win the war against the U.S. dollar. I'm not even suggesting that gold's market share will climb to its former highs. What I am suggesting is mean reversion, meaning that gold, precious metals, and precious metals-related investments, market share of investable assets in the United States will go from less than 1/2 of 1% to 2% or so. In other words, a quadrupling of demand for this asset class in the world's largest investment market. That's precisely what I'm thinking is going to happen.
For more than 40 years, top financial experts and private investors from all over the world have gathered for the New Orleans Investment Conference to discover new opportunities and strategies, exchange ideas, and plan for the coming year. To learn more about today's investing environment and updates, join Peter Schiff, Brian London, Peter Bookvar, Rick Rule, Doug Casey, and dozens of experts at this year's event from the 1st to 4th of November. Go to neworleansconference.com to register. For a limited time, enter promo code PODCAST for a free Gold Club upgrade.
Ricky, you have a lot to go over there as well. You know, your focus on the debt and our other outstanding liabilities, I think, is very important and mirrors what I've been saying. It's gotten to the point where even the federal government, I believe it was a CBO, put out a chart recently showing that the deficits and the debt have grown so large that within just a few years, maybe 2 or 3, we're actually going to be borrowing just to pay the interest on the debt. And one of the things that I've been focusing on in Gold Newsletter is pointing out the fact that this creates essentially an upper bound on the Fed on interest rates because they simply can't normalize rates. They can't get anywhere near normalization. Even a Fed funds rate of close to 3% means about $1 trillion annually just in interest service costs on the debt. So they have a practical upper bound on interest rates, and they simply can't raise rates. As we know, now they're actually focused on lowering rates, and as well as all the other central banks. But what you're saying essentially is that at some point, they will lose control of the market and that the bond vigilantes are going to come in and say, we're not going to take low or negative yields for this kind of risk. We're going to demand far higher yields. And that the central bankers will essentially lose control of that market. Is that a fair representation of what you're saying?
I think it is. You know, if you and I were to do what they are doing, it would be called counterfeiting.
Right.
As simple as that. Confidence continues literally until it doesn't. Mm-hmm. I'm not a psychologist, and I don't know at what point arithmetic overwhelms psychology. But it seems to me that it must.
Yeah, and even if we don't get to that point, even if the central bankers are successful in delaying for maybe another cycle or two, the total abandonment of credibility and the dollar and other fiat currencies, we're still going to have an ultra-low interest rate environment, which means ultra-low or negative real rates. And that's a tremendous tailwind for precious metals and really all commodities anyway.
Yeah, you know, when people criticize the gold investment thesis, they take aim at the sort of alarmist discussions that we have. And I'm not suggesting necessarily the complete demise of the U.S. dollar. I'm not suggesting that gold's market share goes back to 8% like it did in the decade of the 1970s. I'm only suggesting that gold's market share goes from less than 0.5% to 2%, which is a quadrupling in demand for precious metals and precious metals-related equities. The impact that size asset shift would have on the precious metals and precious metals equity space would be astonishing. And frankly, we have an analog, 2000 to 2010. That's the analog. Gold went from $250 to $1,900. I'll say it one more time. That's the analog.
Yeah. And one of the points I like to make to people is, you'll get a lot of experts and pundits up here saying this is what's going to happen. For example, the dollar is going to soar as a safe haven in the near term, and this is the exact path that the next crisis is going to take. What I tell people is nobody can know that. I mean, it really defies its intellectual arrogance to think that you can plot out what's going to happen with any level of detail. But what we do know is that we're reaching very long-term extremes in all markets. And whatever happens over the next few years, you have a good feeling. You can be confident that you want to own gold and gold-associated equities. The risk-reward dynamic has never been or rarely been as favorable as it is right now.
I think you describe it very well. The only time I think where the Where the juxtaposition was better was after gold had been price controlled at $35 for so long.
Right.
Where the price had been actively suppressed. I think something else that both you and I need to say, Brian, in the context of our conferences, is the truism that a 15 or 20% move in the gold price can result in truly outsized moves in the underlying gold equities. That's arithmetic too. If you were producing gold for $1,000 an ounce and selling it for $1,200 an ounce, and the gold price moves up by 15-20% to $1,400 an ounce, while the gold price went up by 15%, your operating margins doubled. And that gives you a sense of the sort of coiled spring nature that's in front of us with regards to the gold equities. If we got to move rather than from 1,200 to 1,400, if we got to move from 1,200 to 2,000, in other words, if the gold price was up by, say, 40 or 45%, what happens is that the industry's margins, the better players at least, can increase by 500 or 600%. And more importantly, mineralized material that was too low grade to mine at $1,200 goes from becoming waste to becoming extremely valuable. So a deposit that might be a 2 million ounce deposit becomes a 6 or 7 million ounce deposit. In other words, the value of the deposit between the margins and the increase in recoverable reserves can increase in value 10 or 15-fold on a 40% move in the gold price. That's why I don't play the game in the short term.
Yeah, Rick, one line from you, which I heard you say before, is that you prefer not to ask the if questions, but the when questions. When you say you don't play the game in the short term, why do you focus on when questions?
Well, when is all about the long term. When I talked about the uranium price at Brian's conference in 1999, I think the best speech I ever gave, the uranium price was at $8 a pound, and the International Energy Agency was saying that the fully loaded cost to produce uranium was $30 a pound. So the choice was either the price of uranium would go up to cover the cost of production, or the lights would go out. And I believed that the answer began with when, not if. It wasn't if it was going to occur, it was when it was going to occur. Nobody knew when, and people were uncomfortable because they couldn't tell you when this blessed event would occur. But the fact is that it had to occur. People were obsessed, or at least people in our industry are often obsessed with if questions. Will this drill hole confirm the surface anomaly? Something that might have a 5% probability of coming true, because they can have their curiosity satisfied in 6 weeks or less. People seem to be willing to risk 50% of their capital to have certainty in 6 weeks or 8 weeks, than invest in a certainty where you are unsure whether that certainty will play out in 3 years or 4 years or 5 years. I have learned as an old man to prefer the time risk to the event risk. In other words, I'm willing to wait 3 years or 4 years for a circumstance that has to come true.
Rick, I'd like to also get your views, because you're in a unique place with really your fingers on the pulse, and your organization has its collective fingers on the pulse of the mining share market and sentiment in that market. Now, I always tell investors, they worry about what's the sentiment in Vancouver and how are people feeling, and I tell them it's really irrelevant because it all depends on where the metals are going, and they're going to follow the metals. If gold's soaring, then eventually the mining share markets are going to follow, and vice versa. But, we've had this little pop in gold, fairly significant, but again, short-term pop in gold. Have we seen much of a reaction yet in the equities and in the sentiment in that sector?
The sentiment in the smaller end of the Vancouver market, that is the explorers and the small producers, is still terrible. It is very difficult for most management teams to raise money in this market. Increases in share prices have been met in the last 3 months with a steady stream of insider selling. People getting what I guess is their first payday in 6 or 7 years. So I would describe the sentiment as terrible.
Why is it so terrible? What's the problem there?
I think that they've been through 5 or 6 years of terror. Expectations for the future are set by your experience in the immediate past. The consequence of living through a 6 or 7 year bear market is that the industry pros here have no confidence. They exude confidence, but we know how that works.
Right.
That's salesmanship. If you look at the insider filings on the small companies here, they're dominated on the sell side. The speculative money in Vancouver, the hot money, is still interested in cannabis, esports, things where they have been rewarded in the immediate past, rather than industries where Vancouver has had a traditional knowledge advantage. It's an interesting circumstance. At the top of the mining business here, places like Tech Corp, B2, the Ross Beatty group of companies, First Quantum, the circumstance is very different. Those companies, their management teams, the long-term professionals, some of the investors rather than speculators in Vancouver, I would describe right now as quietly but supremely confident.
So it's going to take a while then. People need to get some money off the table and then see us gold continue its ascent before we get those first moves in the equity market, the junior equities at least.
I think that's true with the caveat that good discoveries, while rare, see absolutely concerted buying and sell for staggering prices. The takeover by Eldorado of Integra in a very, very bad market is a wonderful example of that. Mm-hmm. Really good discoveries, and we aren't seeing many of them because exploration budgets are low, are commanding absolutely eye-popping multiples. And as you have pointed out, Brian, in your great letter, we're in a mergers and acquisition cycle now, too. We have underinvested as an industry in exploration, in development pipelines, and in mine construction for about 10 years, and the chickens are coming home to roost. The consequence of that is that companies have to get bigger. So companies have to merge just to grow, just to stay alive. Mm-hmm. And this merger mania, which we're in the beginnings of, I believe, adds both hope and liquidity to a market that's in desperate need of both. So it may be that the turnaround is closer than we think.
Yeah, and it really is analogous to the early 2000s when we saw some of that happening as well, like with Placer Dome and the like, and some nice projects fell out of those big companies and were scooped up by juniors. And some of the greatest successes in this whole sector were born in that kind of an environment, and it's very likely we're going to see that again. Now, we've been covering some exciting exploration plays in Gold Newsletter, and I know that you're prohibited for compliance reasons from going over specific names, but where could an investor, I'm wondering, go to find out what are the best positioned companies in this next cycle and some of the more exciting exploration plays?
That's a very, very soft question. I would suggest in the near term attending the Sprott Vancouver Natural Resources Investment Symposium,
of all
and
things.
then afterwards the New Orleans Investment Conference. I'll start with yours. Gold Newsletter has one of the longest franchises in the gold and gold mining business and enjoys a great reputation among the sort of older, I call them the gold elite, the speculators and investors who have been in the gold industry for as long as I have. And the consequence of that proud heritage means that there are exhibitors who have showed up and been serially successful for their shareholders who have showed up at the conference for 30 or 35 years. And doing business with those serially successful people is as good a formula for success as there is. Our own conference, which comes before your conference, is a circumstance where we have in fact done what I describe as curated the exhibitor list. You cannot be an exhibitor at the Sprott conference if your company is not owned in accounts managed by Sprott with Sprott partners and employees as investors. Now, sadly, that doesn't guarantee that every exhibitor at our conference will enjoy a rising share price. Just because we own it does not necessarily mean the stocks go up. But it certainly means that you will be exposed to companies that have been very thoroughly vetted and are in fact owned by us. And I think that's a really, really good way, in the case of both conferences, to get to understand the opportunity that we're talking about today.
Well, you can bet that we're going to include a link to the New Orleans conference in the notes for this podcast. And in fact, we will include the same link for the Sprott Symposium. And the dates again on that?
July 30th through August 2nd. I need to say also, in terms of the conferences, that it is possible, if one works hard, to have a good time in both Vancouver in the summer and in New Orleans in the fall. My wife famously said once that even if I myself didn't attend the New Orleans conference, that she would. It is possible to have a very good time in both cities, and I would urge prospective attendees to work hard, study, and play hard.
Yeah, the website for Rick's event is just Sprott, S-P-R-O-T-T, conference.com. And yeah, the dates are July 30 to August 2nd. And NewOrleansConference.com is our own event. You can get all the links in the show notes at goldnewsletter.com/podcast. Otherwise, Rick, I'm excited to get up to Vancouver soon. So is Brian. So we look forward to seeing you there.
I look forward to seeing you, gentlemen, at both conferences. Thank you so much.
Cheers.
Thanks, Rick.
Bye-bye.
Thank you.